What's up, YouTube Nation? Eric here, Mr. Fired Up Wealth, and December is here, if you can believe that, and you're wondering, Eric, which stocks should I buy now? I've got you covered with 10 stock picks. This is a combination of some of my favorite stocks as well as a few stocks that I've never covered on the channel. I've got you covered from dividend stocks to growth stocks, spec stocks, all covered right here. I like these stocks at these levels and lower for the month of December. Let's get started. Now, you've heard me talk about Tesla before. You know that I'm a bull on Tesla. You either love it or you hate it. Now stay with me. I've got 9 more stock picks and 3 of them I've never covered on the channel before. The reason I like Tesla so much, guys, go out and find me a growth stock at this level, at this price level. This is trading at a 60 PE ratio. The forward PE ratio is actually about half that. Go find me a stock with this type of growth potential at this valuation. I'll wait. You're not going to find a lot, and this is in a class really of its own. There's only a handful of stocks that even fit in this criteria. Now I like this stock lower, of course. I think I could go as low as $150. My target's been $175 or less, and it kind of teased in that range. So at $195, it's bounced off that. If I look at the technicals, it looks like it wants to go higher from here, probably 210, 220. Everything on this channel we talk about is long-term investing, holding it 5, 10 years, dollar cost averaging. So if you're trading, this could be a good short-term trade, but I'm looking at it as a long-term holding and adding. Under $200 long-term, I don't think you can go wrong with Tesla. Can it go lower? Could it go to $150? The answer is yes, but I like it at these levels and lower. Tesla, ticker TSLA. The next stock is Disney, and these are not in any particular order, guys, but the 52-week range, the low on this was $86.28. It's at $97.87 today. I like this stock under $100. Again, dollar cost average, thinking long term. Of course, this company has risk. It's not hyper growth. It's expensive. 55 P ratio. I'd rather buy Tesla at the same P ratio than Disney. But if you're looking for a long-term investment, I don't think Disney's going to go anywhere. They own the Star Wars franchise. They own Marvel. I think the theme parks are going to continue to do well. The cruise ships continue to do well. They have a lot going for them. Disney Plus streaming, ESPN, you know the story. Check out the mouse, Walt Disney, ticker DIS. All right, another one that you either love it or hate it. Now, this is somewhat speculative, perhaps for some of you, but Twilio at $48.86. The 52-week range, it got down to $41. It was a $289 stock at the high on the 52-week range. This one does not have a PE ratio, but it's trading only at a 2x EV NTM revenue on cloud, and they're trying to be profitable in the next year. Now, if that comes to fruition and they're profitable by the end of 2023, I think this stock could go a lot higher. There's been concerns about growth deceleration, but the stock has been beat down. I think it's at levels that are attractive. I prefer 45 or less, but even 50 or less if you're dollar cost averaging long term. Twilio, I think, will be a winner long term. They don't do well in this type of environment if we go into recession, and it might not be an overnight recovery, but long term, I think this is going to be worth more than $50 a share. Check out Twilio, ticker TWLO. This next stock is trading at a 15 P ratio, and it pays you a 2.1% dividend yield. Now, it's not a growth stock. It's a DGI, dividend growth investing type stock. But Kroger just hiked their forecast after strong grocery sales top estimates. Identical sales grew by 6.9%, excluding fuel. The company announced in October it plans to buy its competitor, Albertsons. Now, the thing about this stock is if we go into a recessionary type period, more people are going to eat at home. They're going to buy more groceries. They're going to eat out less. So this is one of those kind of diversification plays in your portfolio. Give you some dividends, get you something that's outside of technology, give you some balance in your portfolio. It's not going to probably outperform the S&P or anything like that. It might perform the market, but it's going to give you a little diversification. So maybe add 1 or 2% of your portfolio in something like Kroger. Ticker is KR. The next stock pick is Google, Alphabet, ticker. I like the A shares, GOOGL. You can also buy C shares. That's GOOG. Same thing, just different voting rights. I prefer A shares. So Alphabet Google is back over $100. I prefer under $100. It got down to $83.34. It's trading at a 20 P ratio. So if I can buy this stock and I'm thinking 5 and 10 years out at a 20 PE ratio or less, in my opinion, that's a great deal. And I think this stock is going to continue to do well long term. Advertising gets hit in this type of environment, so it could continue to have pressure if we see a recessionary type period. But I think longer term, Alphabet, Google, there's so many things that go on for them. You think of Waymo, you think of their advertising business with YouTube and with online with Google.com. There's just a lot going on with this company too. And AI, you've got Google Cloud Platform for public cloud services. It's a conglomerate. It's one that I think should be in every portfolio, in my opinion. I think it's attractive at a 20 P ratio. Check out Google, Alphabet, ticker GOOGL. Now this next stock I've never covered on Fired Up Wealth. It's XP Inc. 52-week range, 1595. The high, 36.36, trading at 17.48. So pretty close to those 52-week lows. Now this one here is a 14 P ratio. Doesn't pay you a dividend. Not the analyst price targets matter that much, but Goldman Sachs just adjusted from 40 to 35. That's a 100% return from here. I think it's underpriced where it's at right now. If you're not familiar with what XP does, so what these guys do, they provide financial products and services in Brazil, offer security brokerage, private pension plans, commercial investment banking, and so on, such as loan operations and transactions in the foreign exchange markets, deposits, et cetera, et cetera. Check out XP, ticker's just XP. Now I've got some more stock picks, so definitely stay tuned. Before I go on, I need to announce this video is sponsored by The Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/fired up wealth. A reminder, guys, they don't tell me what to make, what videos to cover, what stocks to cover. They're a great partner. They allow me to do content on YouTube like this for free, and check them out. It's also coming up on a new year here. It's December, a new month. A great time to join our private community. You can join our Discord and our private community at patreon.com/fired up wealth. Now I've covered this stock many times. I liked it much lower. It got down to $213 at $254. I still think under $250 long-term dollar cost average. It's trading right now, Microsoft at 27 P ratio. So it's getting in that price range where maybe you don't want to buy it quite here. Wait for a pullback if that happens. It pays you a little bit over a 1% dividend. I've had this stock for over 10 years. I've done very well. I think it's a 600% return for me. It's going to continue to do well. Another conglomerate, just like Alphabet, Google. You think of Microsoft Azure for their public cloud services. You think of Activision Blizzard, if that goes through with gaming. They've got all the different segments for Microsoft Office and so on. Very diverse company, lots going on. They have their hands in lots of pots. I don't think this company is going anywhere. Microsoft, ticker MSFT. Now this next stock is going to be spec. So this is spec only, and you have to be careful with it. This under the radar stock can surge more than 60% on a possible treatment for immunoinflammatory diseases, according to Goldman Sachs. Now I've told you many times on the channel, biotech is very hard. They're kind of like lottery tickets. This is spec only. It could give you this 60% return. It could give you a bagger, or the thing could go to zero, it could go out of business. And these kind of stocks can pop 50% or drop 50% in a day. So be careful, do your own homework and your own due diligence on this stock. The ticker is ACRS. The company name is Aclaris Therapeutics Inc. Now it is up 3.94% today on the news at 1582. You have to be careful because this was under $10 in the 52-week range. It was also up to 1896. So it's getting back to that 52-week high. This is a micro cap, spec only, $1 billion. So again, guys, this type of stock is high risk. It's spec only. It could pop or drop anytime. I think there's some momentum right now behind it. It could be more of a trade than a long-term investment, but it could be a bagger stock, $1 billion. It could be a $10 billion company and give you a 10x. So this is a biopharmaceutical company, develops novel drug candidates for immune inflammatory diseases in the United States, operates in two segments, therapeutics and contract research. Check this one out. Do your own homework, your own due diligence, make your own decision. Aclaris Therapeutics, ticker ACRS. Let's mix it up and give you a high dividend stock. This is more of an income stock. ConocoPhillips, never talked about it on the channel. People are asking me all the time, which energy stocks would you buy? This is an 8.87 PE ratio, pays you a 4.2% dividend yield. It's in the energy space. Oil is pretty beat down. It could always go lower, but if oil rebounds to $100 a barrel or more, we've got news right now. They're trying to do different sanctions and regulations and limits with Russian oil, and you know the whole drama behind it. But if oil goes higher, this is one that will do well. It got down to $66 in the 52-week range. So this is up 100% from the lows. It was 138, so you have to be careful, but it's still relatively inexpensive at a 9 PE ratio, and it pays you a nice dividend yield, 4.2%. If you're looking for diversification in energy, check out ConocoPhillips. I don't own it, but I wanted to bring it to you guys. If you're looking for a high dividend type stock, 4% COP. This next one is not a meme stock. This is a legit company. Now it has ran quite a bit from 644. It's at 783. Was a $20 stock. Now if I look at the EV/NTM revenue on a cloud stock like Palantir, it's still attractive. It's still attractive. It's trading right now. It's trading around a 5.7x EV/NTM revenue. Of course, you know there's concerns with this type of a company. Is it too expensive? They're diluting shareholders. I get it, but I do think long term it's going to be worth a lot more than $7.83 a share. So check out Palantir. It might be spec for you. Ticker PLTR. I appreciate your time and attention. Hope you have a great rest of your day. Take care.